Good morning, and thank you to all of you for joining us for another PruViews webinar. My name is Aaron Malton. I'm an investment specialist at Prudential Investment Managers, and joining me virtually today is Gautam Samarth from M&G Investments in London. He's a fund manager at M&G and co-portfolio manager of the Prudential Global Equity Fund. On average for these webinars, we've had around 500 clients joining us live, and it's awesome to be talking to so many of you, and we're thanking you for your time this morning. We ask you to submit questions during registration, and we thank you for the many questions received so far. The questions cover a wide sphere from what is AI, how does Prudential use machine learning, and what evidence is there that AI can substantially improve investment returns. I'll be posing these questions and some more to Gautam, so please stay online to see your questions answered today. We will, however, be emailing you a link to the webinar recording and to the slides after the event so that you can view it in your own leisure if you're unable to stay with us for the full hour. We'll also be sending you CPD certificates post the event, so keep an eye out for that. If you didn't have a chance to submit a question at registration, you do have the ability to pose some questions to Gautam now. We ask that you pose these questions during the webinar instead of waiting till the live Q&A session at the end. Now that all the housekeeping is out of the way, to start, Gautam, could I ask you to introduce your team back at M&G in London to us, please?
Thanks, Aaron. And let me say that, it's an absolute honor to be on this forum with you. Thank you so much for having me on. I'm going to quickly just share my screen, which will be helpful for the remainder of the presentation. So once that's up, yeah, so the systematic equities team over here at M&G, I'm Gautam Samarth, and I co-head it with Mark Beckenstrater. We've been around 3 years almost now, which is quite new, but our quant investment experience actually goes back a lot further. So I'm sure many of the people on this call are familiar or have come across Mark Beckenstrater. He runs some of the offshore multi-asset funds for Prudential as well. What few people might know is that Mark, like myself, actually started his career as a fundamental equity analyst and then subsequently moved on to running concentrated equity portfolios. And while doing this, though, there was one belief that he had that I shared with him along the way, is that systematic processes were vitally important to portfolio management. And so he started developing quant-based product very early on. I think one of the first products that he launched was in South Africa in 2001. And my experience goes back to 2009, 2010, where I was part of the formative quantitative investment team at Credit Suisse in New York. So you can see that our experiences go back quite long. The two other members of our team over here, Egedius and Kay, they have similar investment backgrounds, but they also have deep technical understanding of what's going on in the field of data science. And that's really, really important because as data becomes bigger and the models become more complex, expertise, in addition to domain knowledge, is really important in this field. And the last piece that ties this entire puzzle together is the 11-strong team of fundamental equity research analysts that sit at M&G, which we use in a very unique and quite symbiotic way that I'm sure we can discuss much further on through the course of this webinar. Aaron?
Yeah, thank you, Gautam. So now that the audience knows who you are and who the team is, and the team is quite large, and outside of this, just the 4 people that we saw on screen earlier, there's actually a lot of support involved. Maybe we should take a step back and examine what artificial intelligence is, what machine learning is, and are they the same or are they different?
Okay, great. I think that's a great place to start, actually, because machine learning is showing up everywhere, from self-driving cars to voice assistants. It's becoming a day-to-day part of our everyday lives. But when you ask someone to actually articulate what it is they mean by machine learning or what techniques they're actually talking about, people oftentimes struggle. So what I'll do over the next few slides and minutes is I'd like to take you on a bit of a journey. We'll talk a little bit about the history of AI and the term when it was coined, what techniques are being used in AI in order to come up with some of the outputs. And then we'll make it a little more tangible by talking about some of the achievements of AI in other domains. So if we start with the history then, and the concept of artificial intelligence dates back a lot further, but the term was actually coined in 1955 by a group of scientists led by John McCarthy. So he, along with Marvin Minsky, Nate Rochester, and Claude Shannon, got together in 1955 in Massachusetts, and they wrote a seminal research paper where they hypothesized that every aspect of learning could be so precisely described that machines might be able to simulate it. And they also made a couple of guesses as to what kind of functions, what kind of human learning capabilities might be mimicked by machines, things like language, problem solving, learning from their own mistakes. That really was a seminal moment for AI. And a lot of the predictions or concepts that they talked about in that paper have come to pass today. So we use things like NLP, natural language processing, for language. We've come across machine vision for sensing. But what are the techniques that have been used in order to achieve these outcomes? Well, they've been broad, and as you can imagine, the development cycle has seen many peaks and troughs, but all the techniques have fallen under one of two different categories. It's either been classical programming or machine learning. So let's explore those two concepts. It all really started with classical programming, and it goes something like this. If you assume that you know all the rules that define a particular system, then all you have to do is gather data, apply the rules to that data, and come up with a set of predictions or answers within that system. So you start with data and rules, and the output is a prediction or set of answers. Now that's abstract, so let me make it a little more tangible. Think of things like expert systems in the 1970s and 80s, where this approach became very, very popular. In fields of specialization, especially things like medicine, where there was a shortage of experts, think of infectious blood diseases, it became vitally important that you could code in the expertise of some of these specialists into systems. And they were called expert systems because they were trying to embed the knowledge of these experts and then make these systems available to the more general practitioners out there, so that you could go to a GP, he could use these expert systems in order to diagnose your specific blood disease without having to send you as a referral to an expert who was in high demand and short supply. So if you think about the framework in which this sat, it still sat under those rules were collected by harnessing the information of the experts. Data, aka sometimes diagnostic data about the patients, was applied to the rules, and out came a prediction of likely ailments. Machine learning is very, very different. Machine learning starts with the assumption that you don't know the rules that define a particular system. So then what you have to do is start with data and answers. And once you have data and answers, then you can employ very clever algorithms that learn the rules that connect said data to answers. So over here, the input is data and answers, and the output is rules. And once those rules are learned, then you can apply them in a much more classical fashion. So you take in fresh data, you apply the learned rules to that fresh data, and out comes a set of predictions and answers. And a very good example of this is think of image recognition, right? So how does a machine recognize cats, dogs, different animals in pictures? Well, it learns from pre-labeled pictures where you've identified the cats and the dogs in the picture, and then the algorithm connects different patterns in the picture and associates them with the different animals. So obviously, the more data it has and the more sample of these cats and dogs it has, the better the rules that connect data to answers. And I think what's important over here is also understanding the most valuable piece of these different approaches. So clearly in classical programming, the expert was very valuable because the expert was the one who told you the rules, and therefore you could code them in. When you move into machine learning, the most valuable piece is the data. The more data you have, the better the labels on those data, the better the rules are going to be, and the better the predictions are going to be. So hopefully that gives you a little bit of a flavor. What I'll do is then talk about some of the achievements and make it a little more tangible. So AI has made massive advancements especially over the last decade. And a lot of those advancements have coincided with the development of machine learning techniques. I'd say the biggest one of the last decade was in 2016, where an algorithm called ResNet was able to identify objects in pictures with a 97% accuracy. Now, for context, human beings are somewhere in the 96%, so they surpassed human beings in recognizing objects in pictures. Since that moment, AI has been able to match or surpass human beings at speech recognition, reading comprehension, translation, and most recently, even holding conversation. So they can match human capability in conversation in certain areas. And that might be all well and good because tagging objects in pictures or transcribing speeches, those are pretty mundane tasks that we should be pretty happy to hand over to machines. But that's not the only thing that machines are doing better than human beings. They're actually encroaching upon fun as well. So in my opinion, one of the most impressive feats came in 2019, where an AI system developed by Google's DeepMind division called AlphaStar, it defeated one of the world's best StarCraft players in a heads-up competition 5-0. So for those of you who don't know what StarCraft is, it's one of the oldest real-time strategy computer games around, with competitions dating back to the early 2000s. And ask your kids about this if you haven't played the game, but the level of long-term thinking and strategic awareness required to play this game that lasts over half an hour is quite remarkable, and something that many people thought was not possible from AI systems. Yet here we are sitting and they're beating us at StarCraft. And of course, this isn't the only example of machines beating us in gaming. I mean, the most iconic one was probably back in 1997 when IBM's Deep Blue took on Garry Kasparov and beat him in chess. And the reason I bring up chess is there's been a lot of learnings around AI systems and how human beings can interact with AI systems that have come from the field of chess that hopefully we can talk about through the course of this presentation. But I'll leave it over there for now, and hopefully that's given you a bit of a flavor of what it is we mean by AI, some of the techniques, but also some of the real world applications of where AI is being used. So Zarin, I'll throw it back to you now.
Thanks, Gautam. Well, I don't play StarCraft, but I do play FIFA, and the AI gives me a hiding quite regularly on there. So, I mean, I do know that AI is beating us at our own games quite regularly. But just to summarize what you said and to make some sense of it all for our audience. So basically, AI, machine learning is actually a subset of AI, and machine learning models learn and improve based on data inputs and experience without explicitly being programmed to do so. Is that correct?
That's a very good summary.
Okay, perfect. So now if we turn to investments and the Prudential Global Equity Fund, the question then comes up, why did M&G decide to deploy machine learning in investment management?
Yeah, so to answer that question, Zarin, let's talk about investment management more generally and think about how returns are both generated and accessed in investment management. And I'll share some of our beliefs around it. At the product level, we differentiate between beta component, so the component of returns that we associate with beta, and stock picking alpha. And that beta goes beyond market beta that you would associate with passives or tracker funds to include beta to alternative risk factors like the value factor, momentum, growth, etc. Our belief is that as these beta components get more and more commoditized, it really raises the bar for what a truly active stock picking fund needs to return. So it's not enough if you run a growth fund today to say that you're beating the broad market index. The burden of proof is, can that active growth fund beat some passive implementation of growth? Now, how we do this, or the approach that we've taken, is to leverage machine learning in order to replicate, but also enhance some of the complex decision-making process that an active fund manager would use. So we're trying to access that piece on the red bars on the right-hand side, the idiosyncratic piece, by replicating active fund management using machine learning, but then also enhancing it. Pretty much in the way that machines learned from grandmasters in chess, but then got better. Now you might say, well, why should you do that? Why not just go ahead and employ a very credible, good, active fund manager with a broad research team? And that's a fair approach. Our belief is, though, increasingly industry expertise and experience is just going to be not enough in terms of delivering on your investment objectives. And the reason for that is, if you even take our benchmark, which is the MSCI All Country World, it's got about 3,200 stocks. But when you broaden that investment universe out to all companies that are in the investment universe in the All Country World, that increases to, as you can see on this slide, about 8,500 companies. Now, I don't care how big a research platform you have and how hardworking your research analysts are, there's absolutely no way that you can just cover this entire universe. And so then fund managers have to make some decisions as to how to narrow that investment universe into something that's more manageable. I can talk to my experience when I was running an active fund. We had a watch list of securities that was about 300 companies. And we employed similar sort of screening processes to narrow down the universe to 300 companies, but we were always scared of what we call the error of omission. And what I mean by that is the likelihood that companies that absolutely aligned with our investment beliefs and would have generated very positive returns for the portfolio, but we just absolutely missed out on them because, our process was quite crude in narrowing down that universe. Contrast that to the machine learning algorithm that sits within the PGF equity fund. It looks at all the metrics that a normal financial analyst would look at. So it's looking at over 250 metrics for all 8,500 companies in the universe. And then it's creating a rank order preference of all those companies in your universe. That's such a lucrative place to start looking. And you can still employ your research analyst team, but you can employ them at the back end now. You can say that these are the stocks that the machine learning algorithm have identified as potential outperformers. Can you check them for some false positives where the data might not be right? And there's the added benefit over here of machine learning algorithms are unemotional. So they don't fall in love with stocks. And guess what? If an analyst comes in and says, oh, this one's really risky because there's things going on over there that aren't captured in the data, it's not going to get very cross with you when you toss out its idea for the next one. So there's some sort of team management benefits by employing a process like this as well that takes the emotion out of it. So hopefully that gives you a sense of why we're doing what we're doing.
Perfect. Thanks, Gautam. So now that we know why you're using machine learning, perhaps we should turn more specifically to how exactly it's being used in the Prudential Global Equity Fund and within the M&G Systematic Investment Strategies team. Okay. So moving on to how we are using machine learning, the Global Equity Fund investable universe consists of 8,500 stocks, which, as you can imagine, can be very challenging to gather that amount of data on that big of a universe. Gautam, could you explain to us how you're using machine learning to help you research and analyze the vast universe, and more specifically, how machine learning is applied in the Prudential Global Equity Fund?
Thanks, Aaron. That's a great question, and I'm sure you can appreciate that it's quite a complex process. So what I've tried to do over here is try to develop a bit of a flow chart. It's very simplistic, but hopefully it gives you a high-level understanding of what's going on in terms of mechanics. So machine learning, as we've discussed early on, it starts with the assumption that you do not know the rules that define a particular system, or in this case, you don't know the rules that define equity returns. So if you don't know the rules, you've got to start with data. And the data you start with is both features or certain financial metrics associated with companies, as well as the answers, that's subsequent share price performance, whether the stock's out or underperformed over the subsequent periods. And if you think about it, we're gathering north of 250 of these metrics. So things like price to earnings, price to book, dividend yields, for the entire 8,500 companies going back over 25 years weekly. And if you do that math out, we're learning in this training stage of machine learning from over 1 billion data points. We then employ these clever algorithms to connect said inputs or characteristics to the answers. What are the rules that associate these different characteristics with subsequent share price out or underperformance? This is a very compute intensive phase, and some of our algorithms take weeks to actually train in this stage. But once it's done, we can take these trained models and apply it in the live setting. So we can take in fresh live data, these same characteristics, but on companies in the existing world with their current metrics, and develop predictions on those existing companies. So what you end up with is then not only whether the algorithm thinks that the stock is going to out or underperform, but you also get a relative ranking of the preference of the algorithms. So you can see how valuable that is when you get to the portfolio construction stage, where you have to make complex trade-offs between different stocks in order to fit all the parameters that you're trying to fit into a portfolio. So I know that was very high level, but hopefully it gives you a bit of a flavor of what's going on underneath the hood in our machine learning models.
So effectively what you're saying then, Gautam, is that the machine learning model does the work of an equity analyst, I suppose, where the analyst would analyze a stock, then rate it on a sliding scale from buy to neutral to sell. Is that what you're saying?
That's exactly right. But the beauty is you get to do it over your entire universe of 8,500 companies. Whereas, if you were to get one analyst so that you get the same opinion, they wouldn't be able to cover more than 20 or 30 stocks. And that's the real advantage.
Okay, so effectively the machine learning model does the work of an equity analyst, where the equity analyst would analyze a stock and then rate the stock on a sliding scale from buy, sell to neutral. Is that correct?
That's exactly right. And you've got, the added advantage if it does it over the entire universe.
Perfect. So for the benefit of our audience, you may have noticed that we use a form of AI while on this slide. The AI, the closed captioning on screen uses a form of AI called natural language processing. And you would have noticed that the AI got some of the speech to text wrong. Gautam, how do you manage issues like this when it comes to machine learning and investment management?
Thanks, Aaron. That's a very keen eye. So first, let me say I was actually very impressed by the closed captioning because it managed to get most of the things right. And if you think about it, I mean, I grew up in India, went to college in America, I live in the UK, my accent's all over the place. And I'm pretty sure it didn't really train on a South African accent. So combined, it did a pretty good job, but it did make some mistakes, as you point out. So, when you said sell, it goes to a different word, soul. And, when you were trying things like together, for example, it goes and says together. So there are a few mistakes over there. And the reality is all machine learning models will make mistakes because all machine learning models are biased. How you get around this is you need a level of human intervention. The question is, what level of human intervention do you need? So I said we revisit that chess example and we talk a little bit more about chess. And there's several clues from our learnings of human and machine interaction in chess that tells you where and how to involve the human being with an AI system. So soon after that, that match between Kasparov and Deep Blue, he started thinking. It was clear, the writing was on the wall for him that machines were going to surpass human beings at chess. But what was more interesting to him was, okay, what about humans plus machines versus machines alone? And in order to answer that question, he organized a tournament called Centaur Chess. And it doesn't get spoken about a lot, but it was very, very revealing. So that tournament was a free-for-all. Anyone could enlist as a human being standalone, as a chess computer standalone, or some combination thereof. And with a grand prize of, it was 120,000 euros in the mid-2000s, it did attract some of the best talents from both fields. And some of the results were what you would expect. So by this time, even the best grandmasters were losing to very average chess computers. Compute and the algorithms had moved on quite a bit at that point. So that was not very surprising. What was a little more surprising was when you pitted a human being or a grandmaster alongside an average chess computer and put them against some of the more powerful chess computers, it was still the human and the average computer that came out. So man plus machine was winning over here. And so the natural conclusion would have been, okay, fine. So the winner was some grandmaster sitting alongside some of the best chess computers out there. And that's where things get interesting, because that was not true. The winning combination was actually two amateurs playing alongside three run-of-the-mill mediocre chess computers that were slightly different in construct. And the learning was quite remarkable. When questioned about what differentiated them, they spoke about the time they took to understand the weaknesses of each one of those chess computers and develop a system and sort of a process that complemented, looked for blind spots within those chess computers, and a process whereby which they would override the computers from time to time. And that was a very, very superior outcome. And so the learnings over there were, yeah, clearly man plus machine, or human plus machine, was a winning combination. But the role of the human being in that human plus machine combination changed. It wasn't, let's get the best human that is, usually was competing with the machine. No, it was, let's take the human to identify some of the blind spots of these machines and thereby enhance the overall collective decision making. And that to me was remarkable. It's something that we've taken on board and implemented in the way we design and implement our strategies right now. So to give you a more practical example of how this works, we looked at biased models creating biased or biased data creating biased models. That was the case in the closed captioning, where the closed captioning model probably learned from an American accent and got, Zyron, a couple of your words wrong. Biased data exists in financial markets as well. I mean, it's all over the place. A very common example is what we call the regime problem. So think about the world that we're living in right now. We've been living in falling interest rates, growth outperforming value for the entire past decade. And so if we were to construct a model using data over the past 10 years to predict which stocks might out or underperform, guess what? That model is going to do really well in 2019 if you tested it. So what I'm showing over here is that green bar in the middle. If you took data over that growth period, so the 10 years preceding 2019, and built a stock picking model and then tested it on 2019, it would have done spectacularly well. And conversely, if you took data from the 10 years before that, so that gray area highlighted as the value piece over there, if you took data from that period and tried to build a stock picking model and test it on 2019, it would have done very average. So that gray bar is not very different from zero. And so the temptation would be, well, okay, fine. If you're going to deploy a model, let's deploy this growth model. Look how well it did in 2019 in an out of sample period. Well, the point is a little more subtle than that. Markets are very susceptible to regime shifts, and regime shifts are notoriously hard to predict. So what you'd rather do, and a more lucrative place to play, is try to build a model that covers both regimes, a value and a growth regime, and that can generalize some patterns across both regimes. That's what that pink bar does. And this might seem like a very obvious point, but when you think about 90% of all data in the world was created over the last 2 years, then it's very attractive to go look for these massive amounts of data points coming from unstructured data from Twitter feeds, for example, and to create models on recent data, and then you fall into this regime trap. So we're very conscious of debiasing our models by looking out for pitfalls like this in our process.
Okay.
I'll hand it back to you, Zyron.
Sure, thanks, Gautam. So to turn out to one of the questions that we received from during registrations, do you foresee a time when these machine learning type systematic trading strategies eradicate all alpha from the market? Or do you think the machine learning strategy that you're employing, or the way that you're employing it, has an edge over the strategies that are already out there in the market?
Yeah, that's an incredibly good question. I think there's two parts to that question, Zyron. The first one is actually we could spend an hour debating this, but it whether or not all alpha in the marketplace gets eradicated really depends on your beliefs around what creates inefficiencies in markets. And I'll to keep it short, I'll say that if you believe that alpha is primarily to do with information out there, and that all asset prices contain is news about that asset price, then it's very, very possible that the alpha gets eradicated. And what I mean, so as an example, if you think about the asset as being equities and the news about that asset being earnings news, then it's quite possible that that alpha gets eradicated as machines get very, very good at picking up earnings news and predicting earnings news before it hits the market. If you, on the other hand, believe, as I do, that asset prices, in addition to news about the asset, contain an element of behavioral risk, then as long as human beings are involved in markets, I think there will always be inefficiencies in the marketplace, because whether or not it's the humans directly trading or it's the algorithms designed by the humans trading on their behalf, there's a human element involved, as we talked about in biased models. There's a human being involved in the design of these models. And as long as that exists, then the inefficiencies associated with the market exist. In terms of then what our edge is, and we ask ourselves this question all the time. Why should M&G be able to compete in this space where there's tons of resources? You have literally hours and hours and data centers of compute power being thrown at this problem by some of the big quant powerhouses. So what's our edge? And this is really where I believe that our fundamental backgrounds, both Mark and I, as I've spoken about, come from managing fundamental equity portfolios. That really helps us focus the data science in order to eliminate some of the noise that's prevalent in financial markets. And I like to use this framework of decision analysis to show how we add value all along the way. So think about any problem in the world, really. Any problem set really only has 3 steps along the way to make a decision. So say the problem is, how do you generate investment returns? The way you answer that question is you first go out and gather a bunch of data. You then have to take that data and do something with it, transform it in order to make that data information. Once you've got the data in a useful format, and you can call it information, then you have to do something with that information in order to get some insights out of it. And once you've got insights, then you have to somehow use those insights to make your final decision. I'd argue that the key element to move from the data stage to the information stage is having the right context. And we spoke a little bit about this in our regime conditioning model. So it was having the right context to create your model, knowing that you need data across multiple regimes to create a robust model. But it doesn't just extend to that. That's one of the arguments. It's also what model or what data do you collect in the first place. So things like healthcare stocks need a whole host of metrics that you would look at in order to analyze them that would be very different from, say, real estate equities. So getting the context right and knowing what data to collect and how to transform it is vitally important. Once that data is in the correct form, and you can call it and transformed into useful information, in order to drive insights, you need capable models. And this is where the data science piece comes to the fore. So one of the key assumptions, or one of the key theorems of data science, is something called the no free lunch theorem, which says that every model has an equal number of fail cases as it has success cases. Okay, fine. So if the model can fail as often as it succeeds, which models do you predict, do you use for your predictions? That requires a level of sort of expertise, both on the data science side, but also you need to know the data and the kind of domain that you're playing in. And that's where we bring a lot of value in the modeling side of things. And then obviously, once you have insights, in this case, a series of buy-sell recommendations, how do you make a decision as to which stocks do you put into the portfolio? That's inherently a process of having trade-offs, complex trade-offs, and you need to have an investment process that is systematic and repeatable in order to go from insights to decisions. So hopefully that gives you a bit of flavor as to where and how we're focusing our attention at each decision-making stage of the process. Does that make sense?
Yeah, perfect. That makes a lot of sense. So there's a human embedded in every vital stage of your process. And I guess that leads on then to the next question, which the fear with a lot of South African investors is that these machine learning models sort of adopt a black box approach where you created the model and you're just going to blindly follow whatever the model puts out. What comfort can you give investors that you aren't following a black box approach when it comes to machine learning?
Yes, so that's absolutely right. I mean, we work in an industry where trust is of the absolute essence, and so we've taken a lot of time to actually understand how the models are coming up with these predictions. What are they actually doing in order to come up with these predictions, right? When you think about the phase in which, if we go back to that decision analysis framework, it is when we're moving from information to insight. So this sits in the modeling stage. What we do is for every one of our predictions, we've created a dashboard. In this case, take Amazon as a company as an example, right? So what you're seeing over here is that the alpha score is 54, which doesn't mean much until you rank it, but let's say that's a high score. This dashboard then shows you all the metrics the model considers to be important in determining that alpha score, along with how Amazon, the company, ranks on each one of those metrics. So you can see very clearly that earnings revisions, R&D intensity, and analyst price target are really important and positive for Amazon, whereas sales to EV, which is a valuation metric, is important, but is actually detracting from its score. In order to create these kind of dashboards, we have to take a lot of time to actually understand what's going under the hood of these algorithms. But once you do, it's a very useful tool. And then the last stage of the process, which is going from insights to making a decision as to whether or not to include Amazon in the portfolio. So for example, every stock recommendation that comes out of the machine learning algorithm doesn't go into the portfolio blindly. I mean, we just wouldn't let that happen. We know that machines can't be 100% left to their own devices. Rather, every recommendation that comes out is checked at multiple layers. First, by the fund management team. So that's Mark and myself. We look at all these recommendations and we're looking for things like, are there data errors? So was one of those metrics that was important for Amazon, was one of those metrics erroneous because there was an error in the data that was coming out? Is there something unique happening with the company? Is there a corporate action that makes the prediction less relevant? We then pass on all these recommendations to our research team. And our research team then goes through any of the fundamental risks associated with these companies. What does the income statement look like? What does the cash flow statement look like? Is there balance sheet risk? And this is even the stage where any ESG flags, which are very, very important, will be highlighted. And we analyze ESG risk along with all other risks associated with the companies in order to determine and make an informed decision as to whether or not to allow a stock to enter the portfolio. And only after all these checks happen does a stock enter the fund. So you can imagine that there's robust checks and balances in place before a stock goes from the recommendation engine into the portfolio.
Perfect. So the Prudential Global Equity Fund investment process then effectively combines machine intelligence with human intelligence. But the question then is, how successful has this process actually been in delivering performance?
So the proof of the pudding is in the tasting, really, isn't it, Zaron? And on this front, we're very, very encouraged, cautiously, but we're quite encouraged. As you know, but some of the people on this call might not. We've been running this strategy as a carve-out within the PGF Equity Fund for a little over 2 years, coming up in 2.5 years now. And the results look promising. We've outperformed the benchmark within this carve-out strategy by over 20%, close to 10% annualized. And we're very careful about sample sizes, and we're very aware that this is really still a short sample size, even though it's over 2 years. But we're monitoring other things at the portfolio level, the times in which it's working, how often are these things working, that give us confidence that the things that we're doing in monitoring are all pointing in the right direction. So we're very, very excited.
Thanks, Gautam. You actually touched on a very important point there. And one of the questions, a recurring question that we got during registration is, So how do we know that machine learning can actually sustainably improve investment returns? And how does a financial advisor or wealth manager evaluate the robustness of this process? Like, what should we be looking at outside of sort of cumulative returns and historic performance? How would we analyze the success of the machine learning strategy?
Yeah, as you can imagine, this is something that we're absolutely paranoid about in terms of, monitoring it ourselves. Are we getting lucky? Is it actually working? And the beauty is that these models have been created for statistical robustness. And so we can use statistical measures in order to understand whether it's quote unquote working or whether we're getting lucky. Now, clearly, any sort of probabilistic game can result, so any sort of returns can be generated through pure luck. But probability theory suggests that having good luck over a very prolonged period of time is very unlikely. And you can actually calculate the probability of winning successfully over a long period of time if you can answer these three questions. So in a probabilistic framework, you start with asking, what's your expected winning probability on a single hand or in a single trial of any game that you're playing? And then the next question you got to ask is, how big is your sample? How many times you get to play that game? And then is there any skew in the payout? So when you win, do you win by more than you lose? And this is why casinos are really, really good at actually understanding or predicting their revenue streams or with high levels of accuracy. Because guess what? Take blackjack, for example. You know with a reasonable amount of certainty what the probability of the casino winning any single hand of blackjack. It's about 53% if you assume some basic strategy, right? So that's close to a coin toss on any one trial. But then you say that there's about 70 hands that are dealt on a table in any given hour. And then when you take that, a table is probably open for 8 hours a day. There's about 560 hands a day being dealt on a single blackjack table in a casino. So that 53% probability of winning on one try increases to 68% over any one given hour. And then that increases to almost 95% over the course of a day on any one given table. So you can see why they're so confident of making a profit on a single table on a particular day. That's just how probability theory works over here. So they're increasing the sample size to enhance the likelihood that they're going to win. There's a point to be made about skew over here. In playing blackjack, it's almost the same whether you win or lose. It's slightly negative skew for the casinos because they pay out higher on blackjacks, but blackjacks don't come up very often. So let's say it's about even. Now you can take the same framework and then apply it to portfolio management, right? What is your expected win probability on a single stock? Now, clearly, if you want to create a winning strategy, you want to target something that's above 50%. So in our example, let's just say it's about 52%. Then what's your sample size? Well, you can measure that as well because you can look into the portfolio and you'll see there's about 80 single stock bets in there. And we update those bets every week. So we monitor our trades every week. So you play that out, 80 stocks weekly over the course of a month, that comes to a little under 350 single stock bets that we're making. So if you start with that probability of 52%, you get 346 tries. The probability of winning increases from 52 to about 75%. If, and this is a big if, each one of those bets are independent, because probability theory requires that each one of those tries to be independent from each other. And what that means is there shouldn't be something external that impacts many of your bets in the same way. Now, we know that that's not true in finance. There's a lot of external factors that can impact multiple stocks in your portfolio in the same way, right? So if they react to risky events in the same way, then you don't have a completely uncorrelated bet in each one of those pockets. And so you have to go down and take that 75% confidence and haircut it. But the things that you're monitoring are still the same. You're still monitoring what is your single stock probability of winning? How big is your sample? Combine that to look at, well, we should be winning over a reasonable sample period of time. And, with 2.5 years being our sample, that should be enough for us to gain confidence that the strategy is working.
Thanks, Gautam. But for any client looking at this screen right now, I'm sure they're picking up that 80 stock trades a week and thinking, wow, that must be a lot. So how does the frequency of trading and also the costs thereof affect performance in the fund?
So it's a trade-off, and that's absolutely right. We're turning about 15% of the portfolio every week, right? There's a big, and I understand this because when I started off in the industry, transaction costs were a lot. But with the progression of algorithmic trading, we can execute at M&G for between 3 and 5 basis points on any single company. So think about it. 3 basis points to implement a particular trade. The hurdle, therefore, for not trading a better idea for a less good idea in the portfolio is actually quite high, because when we look back and of the costs of implementing our strategy in the portfolio over the last year and a half, or 2.5 years, sorry, the opportunity cost has been about 150 basis, 1.5% each year, but we've delivered 10% excess returns, and so allowing the model to go for excess returns while sacrificing a little bit in trading costs has been the right strategy.
Okay, that makes sense. Thanks, Gautam. Another question that was frequently asked during registration, and you touched on it a bit when you said that sort of models that every single stock trade can be completely independent from one another. And so that links into the question then, does the machine learning strategy and the Prudential Global Equity Fund then by default follow a particular investment style?
So we don't target investment styles directly, but as you can imagine, when the machine learning is trying to extract patterns that associate financial metrics with share price performance, it might actually uncover that there's certain styles embedded in more favorable versus less favorable predictions. And you see that when you look at the style exposure of the portfolio versus its benchmark. So this is versus the MSCI All Country World, its benchmark. You can clearly see that the fund has a small size bias. It owns small caps relative to the benchmark, but it's also got a positive momentum and high profitability bias. So if you think about an event, and typically risk events that cause people to run for, to chase liquidity, will affect small cap stocks disproportionately. And so if there is an external event, you would expect that this fund, over that short period of time, will be disproportionately affected by the risk event because of its small cap bias. What I'd also say is, over the long term, you'd expect that these style returns to actually cancel each other out. So when you're looking over, 1 month attribution, styles can play an important part in determining the portfolio returns. Over longer periods of time, we'd expect that the styles exposure would cancel each other out or be a slight tailwind. And that's indeed what we actually see when we look back at the data.
Perfect. So I guess you could then say broadly that the model and your strategy, I suppose, is then style agnostic. Would that be a correct interpretation of it?
Yeah, we haven't on purpose embedded style into the way we design the model. It might come out as a bit of a residual, at least when we talk about some of these alternative styles like size, momentum, profitability. But remember, those are things that they're associating with long-term share price out or underperformance. So we don't necessarily try to constrain style too much within the model.
So to unpack the positioning, I guess, just a bit more, we received several questions from the audience relating to the US, China, and FANG stocks. We got questions like, how will things in the US and China affect FANG stocks in the short term under Trump and in the longer term under Biden? So I guess that client's making a prediction on the election over there. But then we got other questions like, do we expect growth in the US and China? So I guess the key question then is, how does the machine learning model deal with geopolitical and sector-specific risks outside of the style risks that we just discussed now?
That's a great question, Zion. And the answer is it really doesn't. And when you think about it, these algorithms can only learn from the data that we give them. And we feed these algorithms financial metrics, so information from the income statement, balance sheet, cash flow statement, annual reports. Nowhere in that data can it find, the risk of supply chain disruptions because of sanctions from a particular company, or interest rate. It can't take that data and try to predict where interest rates are going in the US, for example. And so we can't expect it to then make macro-based allocation decisions when you don't give it macro data. So then what do? Well, you try to stop it at the portfolio construction level from making allocation bets. And so what you can see on the slide over here is nowhere, either at the country level or indeed at the sector level, is there a big over or underweight coming from the PGF equity fund. I think the max weights over here look to be about 2.5%, and that's by design. We don't let it make these big calls that can be swamped by big macro events in the market because we don't teach it to make macro-based allocations. I suppose to some of your questions, it is quite interesting. I believe you're going to have Mark Beckenstrata on in one of these forums in the not too distant future. Now, if you want to know what M&G's views are on some of these big issues, I'd highly recommend you actually dial into one of those calls, because he's not one to shy away from sharing his opinion, and I look forward to dialing into them and hearing his thoughts. So that was a bit of a plug over there. I hope you don't mind.
Nah, doing my job for me over there. But thanks for explaining the macro view, while explaining that the fund actually doesn't make any of those sort of macro calls, and you control for it so that it doesn't sort of by default end up with big macro bets in the portfolio, and that makes a lot of sense. And a lot of our clients will be familiar with how we manage equities locally, and we also try to constrain sort of any, try to avoid embedding any sort of macro bets in our funds as well, and so that makes sense. So thank you, Gautam, for a very insightful discussion. In summary, just to summarize everything that you said, the machine learning strategy used within the Prudential Global Equity Fund combines machine intelligence and human intelligence. And the investment process also has risk management embedded in every step of the design. The machine stock picks are analyzed and assessed by Mark Beckenstrata and Gautam, who have extensive experience as fundamental investors to ensure there are no anomalies in the output. Furthermore, the fund managers are backed by an extensive team of data scientists, IT resources, and a massive cloud computing capacity to ensure the ongoing development of the database and to ensure the constant improvement of the models. Looking forward, machine learning definitely does seem poised to reshape the future of investment management, and we are very excited to be pioneering on this path with M&G in the Prudential Global Equity Fund. We will now answer some of the live questions we received during this webinar. Thanks so much. So we'll now answer some of the questions that came through via the chat function while the webinar was running. Gautam, the first question that occurred quite frequently was, could we please touch on the experience of the machine learning model during pre-COVID-19, then during COVID-19, and also post-COVID-19? How did the model adapt for these effects during this time?
Thanks, Aaron. So it was very interesting actually observing the model and more generally the market during the COVID crisis. I mean, if you look at the timeline, then actually there were warning signs in the news. I mean, the WHO declared COVID a World Health emergency in Jan 31st, but the market didn't peak until mid-February, and then the big sell-off actually happened in March. So there was an asset pricing component, and then there was a fundamental component as well, where there were winners and losers in the marketplace, where the digital type businesses had big profits gains versus others, more physical type of business models. In terms of what the model did then, so it doesn't know that there's a virus in the market in the space that's affecting the world, but it does understand things like liquidity crises, because these happen on and on. Market sell-offs happen quite a few times. So during that March drawdown phase, the fund actually underperformed by about 3%, not significant, but then it recognized that there was a big liquidity crisis happening in the market and pivoted to buying stocks that had oversold. And a significant part of the April returns was the fund buying oversold equities. And then it pivoted back to its old strategy of buying winning business models where earnings revisions were positive and price was supportive, but not crazy in terms of valuation. And so the subsequent return, so from the trough at the end of March to today, it's up about 10% relative. And the mix of returns over there is winning, buying oversold companies. And then once that game was over, buying winning business models that have continued to deliver so far.
Thank you, Gautam. Another question that we got was, what is the time horizon for the machine learning investments? Because we saw the slide which showed that you do roughly around 80 trades a week. But is the time horizon for the investments a week, a month, 3 years, 5 years? What sort of investment horizon is the algorithm targeting?
Yeah, so let me be clear. So when I said 80 stocks a week, we're not trading 80 stocks a week. So we're trading only about five to seven on average a week. We're selling 5 to 7 and buying 5 to 7, but that's still quite a bit. That still amounts to about 15 to 20% turnover a week. The horizon is therefore up to, it's somewhere between 3 months and a year, and that varies. And the reason is quite simple. When you want to train a model, you want as much data as possible. And if you don't want overlapping data series, and then you cut up your 25 years of history, the shorter your focus of time horizons, the more data you're able to create. So we could create longer term time horizons, but we'd have less longer term horizons in terms of investing, but we'd have less data to train on. And at the end of the day, the way we see it is 3 years is just a function of, is a section of 3 individual 1 year periods. So if it works over 3 years, you should be able to make it work over single years as well.
Makes perfect sense. One of the questions that we got as well, and this is sort of more a operational type question, was which platforms is the fund available on? So just to let everyone know, the fund is available on most international platforms and all open architecture platforms, but just to name a few, the fund is available on Glacier, Investec, Global, Old Mutual, International, Momentum, and Stanlib. We also got a few macro questions, and Gautam did refer to it during the presentation. Mark Beckenstrater will be doing another webinar on the 8th of October, so please dial in then to see some of your more macro and asset allocation type questions answered. For now, I'd just like to say thank you to all of our clients for joining us. It's always a pleasure to have so many of you interact with us all at one time. So a big thank you for your time and your ongoing support. If you have any further questions, please reach out to your Prudential client representative, and we'll try to get those questions answered for you as soon as possible. Then finally, I'd like to thank Gautam for your time this morning. Gautam, it is greatly appreciated. Thank you for interacting with us and with our client base. And with that, we'll end this webinar.
It's a pleasure to be over here. Thank you so much, Aaron.
Perfect. Thank you, Gautam. Cheers, everyone.
Cheers.